Retirement planning just got a whole lot better in 2025 thanks to Secure 2.0. I'm going to give you the scoop on some fresh changes to Roth 401ks and other retirement plans. These updates aren't just tweaks, they're game changers designed to give you more freedom, more flexibility, and less tax stress. The big mission behind Secure 2.0? Well, it's simple. Get more people saving for retirement because it might not be a good idea to count on Social Security being there once you retire. First, let's get the new catch-up contribution limits out of the way. If you're between 50 and 59 or 64 or older, you can throw in an extra $7,500 per year. But if you're in the golden window of ages 60 to 63, you can make a supersized catch-up contribution, an extra $11,250. There is one important detail though. You've got to be at least 60, but not a day older than 63 by December 31st to cash in on that extra boost. For most people with a simple IRA, the supersized catch-up contribution for those ages 60 to 63 is $5,250 for 2025. The regular catch-up contribution limit for you is $3,500 for 2025. The next change to retirement plans for 2025 is that the dreaded required minimum distributions are no longer a thing for Roth 401ks. That means once you hit retirement age, the government won't force you to pull money out of your account. You can just let it sit there, hang out, and keep growing tax-free. Yes, just like traditional 401ks, Roth 401ks did have required minimum distributions, even though withdrawals from Roth 401ks were tax-free. But now that's history. This change brings Roth 401ks in line with Roth IRAs. No more odd regulation differences, just simple, streamlined retirement savings that let your money grow on your terms. Oh, and just a side note about RMDs. If you inherited an IRA or a 401k and thought you could ignore required minimum distributions, think again. The IRS had been giving folks a little grace from 2021 through 2024, but starting in 2025, if you skip your RMD, you could face a 25% penalty. Okay, on to the next change for 2025. Before January 1st, 2025, if you wanted to join your company's 401k or 403b plan, you had to actually sign up. Fill out paperwork, check some boxes, all that thrilling stuff. Now, that whole routine has flipped upside down. Now, if you qualify for your company's retirement plan and you're not already enrolled, your company will automatically enroll you in a retirement plan. Most employers have to follow this new policy unless they're super tiny, like 10 employees or less, a church or a government agency. Your first automatic contribution will be somewhere between 3% and 10% of your paycheck. And every year after that, your savings rate will tick up by 1% until you're putting away a comfy 10% to 15%. And don't worry, you're not trapped. If you can't afford to save right now, you can opt out or change your contribution rate anytime. So basically, saving for retirement has become the new default setting. Actually, the IRS rolled out some game changers for part-time workers too. Starting in 2025, if you're working part-time, you'll have a better shot at jumping into your company's retirement plan like 401ks and 403bs. The deal is pretty straightforward. Clock at least 500 hours a year for 2 years in a row, and boom, you qualify to start stacking up savings in your employer's retirement plan. This is a huge win for part-timers who, in the past, were often stuck on the sidelines. Now, once upon a time, when you contributed to your Roth 401k, your employer's matching money had to go into a traditional 401k. Of course, that's not exactly the tax-free fairy tale you were hoping for, but guess what? The rules have changed. Now employers can directly deposit their matching contributions into your Roth 401k. That means their match grows tax-free and you can withdraw it tax-free too. But here's the plot twist. Those matching dollars will count as taxable income the year they're added to your account. Oh, and one more thing. Roth matching is optional, so not every employer is jumping on this new train. Be sure to check with your company to see if they're offering this new perk. Have you ever misplaced your keys, your phone, your 401k? Yeah, it happens more than you'd think. Thanks to Secure 2.0, there's a searchable database designed to help you track down those long-lost retirement benefits you might have forgotten about. This retirement savings lost and found is set up at the Department of Labor, and I will include a link to it in the description box. And here's why it matters. Right now, millions of 401k accounts are just sitting out there gathering dust, totaling close to $1 trillion in unclaimed retirement cash. It might be worth it to check just to see if you have anything out there. Although the next few items were put in place before 2025, I wanted to mention them anyway, just in case you don't know about them already. Saving for college, paying off student loans, building an emergency fund, retirement savings. Trying to do all of this at the same time is a lot, right? Well, 2024 brought in some new changes to make all of that juggling a tiny bit easier. Let's start with the parents out there, the ones stashing cash into a 529 plan for their kids' college dreams. Here's the good news. After 15 years, if there's extra money left over, you can now roll it into a Roth IRA for your kid. There's a cap though. You can only roll over as much as the annual IRA contribution limit allows, up to a lifetime max of $35,000. And for all of you drowning in student loans, there might be help for you too. Thanks to Secure 2.0, your loan payments can now help your retirement savings. Here's how. If you make a qualified student loan payment, your employer can match it into your 401k, 403b, or simple IRA, just like they would a regular contribution. The catch? Your employer has to actually offer this perk. Fingers crossed. Now let's talk emergencies. You know, the surprise car repairs, unforeseen vet visits, or I don't know, your fridge gives up on life. Before, if you dipped into your 401k early for an emergency, you'd get hit with the heartless 10% penalty. But starting in 2024, you're allowed one emergency withdrawal of up to $1,000 per year. No penalty, no 10% tax. You can even repay it over 3 years. Just remember, if you don't repay, you can't tap into it again during the 3-year repayment period. And finally, you might be able to get a little extra put into your rainy day fund. Employers can now offer a pension-linked emergency savings account like a built-in piggy bank. If your employer offers this perk, you'll automatically be enrolled at up to 3% of your salary. The account maxes out at $2,500, and once you max out, contributions will stop, or some of the balance can be rolled into your Roth 401k if you have one. And get this, there are no fees for the first 4 withdrawals a year. And when you leave your job, you can either cash out or roll it into a Roth IRA. Oh, here's something that will start in 2026. If you're a high earner, Uncle Sam has new plans for you. Your catch-up contributions will need to go into a Roth account. Originally, this rule was supposed to kick in last year, but the IRS hit the snooze button and delayed it. Here's the thing. Making catch-up contributions on a Roth basis means coughing up taxes now rather than later in retirement when you might have less income. But there's good news for the middle class. If you make less than $145,000 a year, this new regulation won't apply to you. I talked a lot about Roth 401ks in this video, but small business owners often miss out on this retirement savings option. But if you have your own business and you are a solo owner, you might be able to benefit from a solo Roth 401k. If you want to hear more about how it works, please watch the video in the upper left of the screen. See you next time.